For our Did You Know segment today, we're going to discuss non-QM loans and how they work and who they're beneficial for. Non-QM. First, let's start off there. Again, acronym city, here we come. Non-QM means non-qualified mortgage. So non-QM, non-qualified mortgage loans, cater to the borrowers that don't fit the more rigid guidelines for Fannie Mae, Freddie Mac, and the FHA. And those are government-backed mortgage programs. Non-QM loans are not government-backed. Now, that doesn't necessarily have much of a tangible difference other than the fact that there are some mechanics when you have a government-backed loan, and there's certain safeguards. But there are lending guidelines broadly that even if it's a non-QM loan, there is a safety and security that's built into how the lending environment currently operates in the United States. These non-QM loans offer alternative ways to qualify and alternative ways to verify income, creditworthiness, and they could be valuable options, particularly for self-employed borrowers, business owners, and real estate investors. I'm going to first talk about bank statement loans. Non-QM bank statement loans are a very popular type of non-QM loan. These use bank statements and deposits actually received by a self-employed individual or business to generate a qualifying income number, and we do that by reviewing anywhere between 12 months of bank statements all the way out to 24 months. Generate what the cash flow looks like, and then apply an expense ratio factor. And that essentially takes that gross number of what all those deposits gathered over 12 to 24 months looks like, and then lop off a percentage of it as an expense ratio, because every business has expenses. There's a couple different ways that operates. One way is just through the guidelines of the program. I can speak to what we offer at Rate. We have a handful of different investors. We also have some proprietary programs for non-QM loans that just have guidelines and say, well, we're going to just apply a 50% expense factor, which means we take 100% of the deposits gathered, average it out, and then cut it by 50%. That gives us our effective income. There's also some guidelines that permit for us to engage with the CPA of the business owner or self-employed individual for them to provide us with the expense ratio. They would have to provide us with something, but that is something that is a way that we could navigate around having to take out 50%. It's a possibility, but out the gate, normally we're just taking 50% of the gross deposit average, and that's becoming our qualified income. The documentation, again, this is 12 months or 24 months of bank statements that's required. The pros of these loans, well, it's giving you a little bit more flexibility on the income verification. You know, if you have a business and you have a great accountant, they're identifying as many opportunities to write off expenses for you as possible to lower your overall tax burden when you file your taxes. Well, if you do that, our conventional guidelines, which are set forth by Fannie Mae and Freddie Mac and the FHA, they require us to use your net income as claimed on your tax returns for qualifying income. So you can make $1 million a year, but if you write off $990,000 in expenses, well, you only have $10,000 worth of effective income. That may not translate to what you actually feel by way of income, but in a case like that, these non-QM loans could be a great alternative for us to review and explore. There's also a faster approval process with these because we're not verifying through multiple different methods. It's kind of exclusively on your bank statements and maybe a letter from your accountant. That gives us some flexibility on our timeline. We could move quite a bit quicker on that approval process. Also, this opens up homeownership opportunities. So for those who have been self-employed for a number of years, have a well-run business, and they have stable income by way of the deposits coming into their bank account, but they write off a lot of expenses, this can actually be the difference between not buying a home and buying a home. So it's a very helpful program, especially now. Now you're probably thinking, hey, this is all great news. What's the catch? Well, here's the catch. It's more expensive. These mortgages are normally carrying a much higher interest rate, but not always much higher. There are ways to mitigate that. So some of them do require higher down payment amounts, around 20%. Most require a much higher credit score than the minimum required for Fannie Mae, Freddie Mac, and the FHA. Somewhere it could be between 680, 700 credit score, middle qualifying score. So these are some other hurdles. But if you put more money down, remember, mortgage rates, beyond the market component, which we talk about every week, they are also very unique to you and your financial situation. They're called risk-based priced. The risk is based upon your loan characteristics, your down payment amount, your credit score, your debt to income ratio, how much money you have in reserves. All of these things play a role. So if you have a lot of money in reserves and you're putting a sizable amount of money down and you're leveraging one of these bank statement loans, your interest rate doesn't necessarily need to be much higher, or you have the option, as we talked about a few weeks ago, to leverage discount points, to absorb whatever is affecting your mortgage rate and pay a premium up front for a lower interest rate or a closer to market or market interest rate by paying those discount points up front while you're leveraging one of these non-QM loans. So who benefits? I already mentioned. We talked about self-employed, gig workers, business owners, and the one group that we didn't discuss because we were focused on our bank statement loans are real estate investors. Real estate investors can benefit from non-QM loans because there's also a very particular loan program available that's called a debt service coverage ratio loan. That is DSCR. Remember, acronym city, we're here again. So DSCR is exactly what it sounds like. We qualify essentially based upon a client's or a real estate investor's asset position, how much money they have. This is inclusive of reserves and the money they'd need for down payment and closing costs. Their credit score, you need to have a higher credit score for these loans, and what the cash flow is for the property. That's it. We do not delve into personal finances other than what I just outlined. If we are able to verify those things and the property that the real estate investor is interested in purchasing cash flows, which means if it makes sense for you as a real estate investor, it makes sense for us. If you are obtaining a property and it's cash flowing where your mortgage, principal, and interest, taxes, insurance costs are less than what the gross rental amount is for that property, that's your approval criteria. You're good to go. Again, those loans do carry with them higher interest rates, sometimes by a large factor, but sometimes not. There were times, and I can say for some real estate investors I've assisted over the past few months, that comparing these non-QM DSCR loans to your Fannie Mae or Freddie Mac conventional investment property loans actually come out ahead. You come out on top doing the DSCR loan. So it will depend largely on credit score, largely on down payment amount. The more money you put down and the more money you have in reserves, the better the terms are going to be for your mortgage rate. So your interest rate could be lower if you have strong qualification factors for all of those things. My final thoughts on non-QM loans. They are a great option, especially if you run into no. So I have a message out there today for anybody who's listening, who has tried to get approved for a mortgage and have been turned down by banks who've only looked at conventional and standard ways of qualification. This is your call to action. Reach out to me, follow me on socials, reach out to me via email. I can possibly help you here because these loans are tremendously powerful. They do take quite a bit more on the front end so that we can ensure all of our ducks are in a row. But then again, that's the proper way to do business in this current competitive environment. If you are getting your financing put together, you're going to want to make sure every box is checked, every stone is uncovered, and everything is buttoned up nicely so that when you place an offer, you have every bit of confidence that you won't run into issues moving forward.